Hello, good morning to all and happy Friday. Welcome to today's Daily Dose of Market Insights by OANDA. I'm Kelvin Wong here, the Senior Market Analyst of OANDA Asia Pacific. Happy Friday and good morning. Today will be the 16th of February 2024. So before we start our Daily Dose of Market Insights, let's take a look at the disclaimer slides first. All right. Leverage trading carries a high degree of risk and may not be suitable for everyone. Losses can exceed deposits. This presentation is not an offer or solicitation to buy or sell, nor financial advice or recommendation for any investment product, as well as any forecast, prediction, or projection in this presentation is not necessarily indicative of the future or likely performance of the product. This advertisement has not been reviewed by the Monetary Authority of Singapore. All right, so as usual, before we jump straight into the short-term technical outlook on the various cross-asset classes, ranging from the major stock indices, the major FX pairs, gold, which is spot gold XAU/USD, and as well as West Texas crude oil. Let's have a recap of what happened overnight in the US session. So overnight in the US session, let us start with the major benchmark US stock indices. So all of them actually posted a second consecutive day of positive return after that minor sell-off on Tuesday. So if you recall that what happened on Tuesday, Wednesday, there was this shocking, hotter than expected US CPI data, but that actually didn't derail the short and medium term ongoing uptrend of the major US stock indices. So yesterday performance was actually more of a rotation play, where the Nasdaq 100, which is heavily concentrated in the mega 7 cap tech and growth stocks cohort, underperformed yesterday, but with a slight positive gain of positive 0.21%. That's for the Nasdaq 100. The outperformer actually comes with the Russell 2000, positive 2.45%. So the Russell 2000 is actually consists of small cap US stocks that has a weaker balance sheets compared to the rest of the companies in the S&P 500, the Nasdaq, or even the Dow Jones. So later I'll explain why the Russell 2000 actually outperformed yesterday. It's actually due to a continued pullback in the 10-year US Treasury yield. The Dow Jones Industrial Average also managed to perform better than the Nasdaq 100, positive 0.91%. And lastly, the SPX, which is the S&P 500, gained by 0.58%. And with that pullback in the US 10-year Treasury yield yesterday, gold managed to inch up higher at 0.6%, slightly playing around that 2000 psychological level. DXY as well, the dollar index, where you see the dollar strength give back a bit of gain as well at negative 0.41% yesterday. And due to the ongoing very I would say fluid situation in the Middle East, because there is ongoing situation where there could be a potential peace treaty between Hamas and Israel, but the situation is not confirmed. I think yesterday some Israel officials saying that whatever peace deal is still not on the cards with Hamas. So that actually saw crude oil, WTI crude oil actually rallied yesterday, positive 1.4%, but still maintained below that key range resistance of 78.4 US dollar per barrel. Okay, so that is the outlook of what happened yesterday. So we could see that before we jump straight into the key economic data releases for yesterday, let's have a look at the heat map of the S&P 500 first. So this is what I explained over here, is that what we could see is a rotation of the mega cap 7 stocks spreading into the rest of the other markets that has lower market cap. All right, so that's, I would say, that it's more of a healthy rotation, even given the fact that we can't have the mega cap stock keep outperforming, despite the fact that on the longer term they're still outperforming. But on the intraday basis, we see a bit of rotation back and forth, which is still a healthy sign, indicating to us that the short-term uptrend on the major US stock indices still remains intact for now. All right, so now one of the data that actually we will look out for is this very interesting data over here. Is, let us take a look at yesterday, right? Yeah, we go to the US market first. All right, the retail sales. All right, so you know that retail sales is a very important data in the US. Why? Because I would say close to 2/3 of the US economic growth is depending on consumer spending. which is directly linked to retail sales. Okay, so you look at retail sales over here is that yes, it's a month-on-month figure. So this month-on-month figure actually plummet. So it actually declined by negative 0.8%, way below expectation of negative 0.1%. So if you look at the trend, okay, because it's a month-on-month figure, it tends to be much more erratic over here. Okay, so if you could have the thing over here, that is this retail sales. Okay, if you look at the year-on-year figure, all right. Okay, so for year on year, right, even that January figure was also very low at 0.6% over here. So if you look at the 5-year, the trend, it's actually inching downwards. So what it means that over here is that there are some economic metrics that indicate to us that consumer spending, yeah, even though they are still spending, but it not be so robust as before, as the positive growth trend is decelerating. So what it implies over here is that sooner or later there could be a chance that the Fed got to actually start to actually reduce its current high level of Fed funds rate, which is at 5.25% to 5.5%. All right, so it's kind of balanced out right now over here. So for sure, chances of it hiking, I mean, reaccelerating its hike is pretty much remote, right? Because there are some signs in the US economy to indicate to us that it's not sustainable in terms of continuation of demand growth to maintain at this high level of interest rate, all right? But so there is still possibility of the start of a Fed dovish pivot. So the question over here is only when will be the first interest rate cut takes place, and as well as the number of cuts for this year. So as we know that there are some data that is hotter than expected, especially non-farm payroll data that is still showing that overall the US job market is still robust. I mean, employers are still hiring. Overall, despite the fact that we know that certain tech company are laying off workers. US CPI came in hotter than expected, and there are certain indications that it may continue to be this level. So with that, if you put everything in the net effect over here, is that the CME Fed Fund futures pricing for sure right now is that for March, initially at the start of December, and so at the start of this year, there's actually high hopes for the first cut to come in March. But more or less, if you put everything, netted everything together in whatever, in all the economic data that we have, the pricing right now is very low chance that we will see the Fed to start reducing in March. Okay, not hiking, reducing, pardon me, reducing in March for the first interest rate cut, only 10.5%. So that's almost killing off the expectation. Okay, so if you put it in May, so before the hotter than expected US CPI data of this week, there's actually about 50% chance that the first cut will come in May. But right now that's also been reduced as well, only 36%. Previously we talked about 50 to 60% a week ago. So right now the market has been pricing on, I mean the pricing of the first interest rate has been pushed backwards to come only in June. All right, so if you look at June data, if you put it over here, because there's actually a 53% chance indicating for a 25 basis point cut, and 23% chance indicating for a 50 basis point cut. So you add these two numbers together, it's somehow about 70% plus. All right, so that will be the market expectation right now. But what we could see over here is that if you look at overall, the combined probability, let me explain it over here. Initially, right, it was being priced 6 interest rate cut before 2024 ends. So that's about that was about 1.5 months ago. So somewhere around late December, early January. So that actually happens right after Jerome Powell, which is the Fed chair, gave his dovish stance during the FOMC meeting in December. Okay, so during that time, the dot plot, they actually up the MT by telling the market there could be a projection where based on the Federal Reserve official median projection of 3 interest rate cut for this year. So market jumped the gun by pricing in twice. But right now, the pricing, if you go down diagonally by looking at it over here, March and June, there's 1, 53%, 42%, slightly higher, 2, then 36%, 3, in September, then all the way down to the December one. Okay, 1, 2, 3, 4. All right, 32.5%, only 32.5% pricing in December. So what we could see over here is that the number of expected cuts being priced by the futures market, the Fed Fund futures market, as indicated by this CME Fed Watch 2, has been drastically reduced from 6 to 4, roughly moving in line with the US Federal Reserve latest dot plot projection that was released much earlier during the during the December FOMC meeting. So coming in March over here, they will actually start to release their latest dot plot as well. So that will be a pretty much scrutinized, we call it projection by the market. This given the fact that we now start to see a fresher CPI data, fresher retail sales data, fresher new sets of economic data that is pertaining to the job market. So market will be pretty much curious that will the Fed starts to reduce this interest rate cut projection during the March meeting, or will they maintain it? All right, so if they reduce it over here, for sure, the US 10-year Treasury yield will start to spike up again, and that could actually put the ongoing medium-term uptrend on the US stock market in jeopardy, i.e. that we also start to see a much more resurgent in dollar strength. But for now, we are taking things one step at a time first. All right. Then another data I want to highlight over here is the UK. So UK actually went into recession, technical recession, in Q4 last year. Why? Because what we could see over here is that the GDP fell 0.3%, 0.3% in the fourth quarter, way below expectation of 0.1%. So what you could see over here, this is the trend of a deceleration, but then the pound actually sold off as well. But what we could see over here is so far there's certain indication, especially from the BOE governor. Okay, let me expand my screen so that you guys could see much clearer. Okay, so the BOE governor, oops, where is it? Yeah, BOE governor, he actually played down the significance of the technical recession. Okay, this week, I mean, there was actually a speech by him earlier on, pointing to signs of upturn in surveys covering the start of 2024. So what he means that over here is that he did expect that whatever, because you know that GDP tends to be lagging, so it's based on whatever he sees or his opinion on certain survey-based economic findings, readings, he do expect there is a potential upturn coming into play for this year. All right, so that is pretty much of a optimistic outlook by the BOE itself. All right, so so yes, so despite the fact that we know that so there could be a signs, given that that is his stance right now, it seems to us that BOE may not be so dovish in terms of kicking start their first interest rate cut as well. Okay, so the first interest rate cut may come maybe somewhere around much later, similar to what the Fed later part of this summer instead, rather than the first half, the Q1 of this year. Okay, so now with that, right, let's take a look at the short-term technical outlook chart. Okay, so what I'm going to do over here is let me expand my screen so that you guys could see. So let's start with the FX market first. So over at the FX market, this is the 5-day rolling performance chart as of today. So what we could see over here is that the dollar strength, that this is the push up the dollar strength overall, and it slowly starts to get dissipated, and right now it starts to pick up again during today's Asia session. So overall, it's more of a choppy session, still pretty much sideways from a 5-day rolling performance basis. So it will stretch further from a 1-month basis over here. Okay, what we could see over here is also a pretty much dollar strength that is still slightly intact because of it's still sloping upwards. You look at it from a 5-day rolling performance basis. So overall, to me it seems to be there's still much of a mixed picture with a slight dollar strength that is still inherent in the market right now. Okay, so with that, right, let us take a look at the European currency, the euro dollar. So the euro dollar, right, yesterday it managed to play around with the short-term pivotal resistance that we have at around 1.076, but failed to break above the upper limit of this descending channel that is in place since the high of 11 January this year, and also pardon me, right exactly at the 20-day downward sloping moving average, which coming to act as a resistance as well as this 1.0795 level. Okay, so with that, right, and also right now, if you look at the current situation, the RSI has managed to hit the overbought yesterday, and it exit the overbought, and the way it exit overbought over here, it starts to break down below a parallel ascending trendline support level. Okay, so with a kind of bearish momentum that has been depicted right now in the hourly RSI, we will still maintain that short-term bearish bias with an adjusted short-term pivotal resistance for today. For sure will be this important level at 1.0795, which confluence with the descending channel resistance and the downward sloping 20-day moving average, and as well as the minus swing high area of 13th of Feb, where it hit and saw that steep sell off intraday upon the release of the hotter than expected US CPI data this week. Okay, so 1.0795 will be my key short-term pivotal resistance. First support level, still maintain that short-term bearish outlook on the euro dollar. First support level to watch will be at 1.0725. Okay, for today. However, then thereafter, a breakdown below it exposes the next support level at 1.0665. So, however, an hourly close above 1.0795, we'll start to see much more pronounced US dollar weakness, then where the euro dollar could actually expose the next near-term resistance at 1.0890, which confluence with the downward sloping 50-day moving average, and as well as the minor range resistance of 26th of Jan to 2nd of February. Sterling dollar. So sterling dollar remains choppy here. Okay, so this we have two levels to watch in terms of resistance level to maintain that short-term bearish bias. So price action hit the first resistance level, which is 1.2610, and it managed to shape that pullback, that sell off. Also corresponding with the downward sloping 20-day and 50-day moving average still remains at around our short-term pivotal resistance that we highlighted yesterday, which is 1.2670. So no change. You'll be using 1.2670 as my short-term pivotal resistance. I don't want to put it so tight at 1.2610 yesterday because it's still pretty much choppy right now. It's ranging between a consolidation pattern. So it could be a triangle. All right. So if you look at the trend line that I draw, okay, it could be something like a symmetrical triangle configuration that is involving with the upper limit at 1.2670. So I don't put it too tight at 260 in the middle of a triangle. We get whipsaw easily. So 1.2670 will be the key short-term pivotal resistance for today. Still maintain that short-term bearish bias. First support level to watch will be at 1.2540, which is the minor swing low of 14th of Feb and 15th of February that was tested yesterday and survived, and also potentially the lower limit of this potential impending minor symmetrical triangle as well. Only an hourly close below 1.2550 will expose the psychological level at 1.25 figure level. However, an hourly close above 1.2670 will negate this bearish tone on the sterling dollar to see the next near-term resistance zone coming in at 1.2640 / 1.2660, which is the upper limit of this range resistance that is in place since 15th of Jan to 2nd of February. All right, now moving on will be the Asia Pac currency. So let us start with the Aussie dollar first. So Aussie dollar, what we could see over here is that it's trying to play around that 65 figure level and the 20-day moving average that is acting as a resistance at 65.40, which is also confluence with the minor swing high area of 7th of February and 13th of February, and as well as this minor descending resistance that is in place since the high of 1st of February, all pointing towards 65.40. So what's interesting over here is that yes, yesterday it did a push up above 65 figure level, but after that push up, right, that RSI start to shape a bearish divergence. All right, so similar high, but very clearly lower high on the RSI, and the RSI after that bearish divergence, it exited from the overbought level and broke below this parallel ascending trend line support level. It did a breakdown, so indicating to us that there are some signs of bearish momentum that is inherent in the hourly RSI oscillator, indicating to us that some short-term bearish elements have started to emerge in the Aussie dollar. So with these bearish elements that I share with you, that I portray on my screen, we will still maintain that short-term bearish bias, but with adjusted short-term pivotal resistance right now at 65.40 for sure. So this is the key clear short-term resistance that you got to surpass to actually negate this ongoing bearish momentum that's being inherent in the hourly RSI. But for sure, first support level to watch will be like the 65 figure level. 65 figure level broken down exposes 64.50, which is confluence with the minus swing low of 14th of February. Hourly close above 65.40 will invalidate this bearish short-term bearish bias to see the continuation of the Aussie dollar strength, at least in the short term, towards 65.70. A breakout above it, see a retest of the 50-day moving average, acting as a resistance at 66.20, which confluence with the minor range resistance that is in place since 24th of Jan to 31st of Jan. All right. Dollar yen. So dollar yen continue to be a trade within our neutrality range, hit down the lower limit of the neutrality range at 149.60 before it bounces off. So no change. Maintain that neutrality level between means a range between 150.70 and 149.60. Only an hourly close above 150.70 will potentially see a squeeze up to test the major resistance zone at 15140/151.95. All right, so what we could see over here is pretty much of a dollar strength mixed bag story that is showing right now, but with the Aussie dollar remaining on resistance, followed by the sterling dollar, and the euro dollar still remains on resistance for now. Okay, so it's only the dollar yen is pretty much mixed, trading in a range. All right, now major stock indices. So major stock indices, let's start with the Nikkei 225. So very strong push up in the Nikkei 225. So Nikkei 225 previously we have a very short-term resistance level to watch around 38 700 has been made, and right now it's coming very close to the current 30 plus over years of fresh all-time high at 38,957 that was met in December 1989. So we finally comes to a full cycle. Okay, so for sure, what's interesting over here is that price almost hit the level. There was a bit of profit taking, but right after this profit taking, we see signs of short-term bullish buyers coming back into the market. Okay, with the hourly candle that is bouncing over here. Okay, positive, and where it bounced right at the lower boundary of this short-term ascending channel that I drew from the low of 7th of February. And also what we could see over here is that the RSI managed to be remains supported, all right, by this parallel ascending channel that I drew from the start of 7th of February. Tested one time, tested twice, tested again, and bounced. And where it bounced off above the 50 level mark. So indicating to us in short term there is still the bullish momentum still remains intact, at least in the short term, as depicted by the hourly RSI. So with that positive elements remaining intact that I shared with you earlier on, price action followed by RSI momentum indicator on the hourly chart, we will still maintain that short-term bullish bias on the Japan 225. With a tightened short-term pivotal support level for sure will be at this 38,260, that confluence with the lower limit of this minor ascending channel, and as well as the former minor swing high that was seen on 13th February now turns into a pullback support level, confluencing at a similar level at 38,260. So 38,260 short-term pivotal support to maintain this ongoing short-term bullish bias on the Japan 225 or the Nikkei 225. First resistance for sure will be the all-time high level at 38,570, then followed by the Fibo extension cluster level at 39,210 level. Okay, then thereafter will be 39,510, 39,600, another FIBO cluster level, all confluencing with the upper limit of this ongoing minor ascending channel that is still in place since 7th of Feb low. Only an hourly close below 38,260 will negate this bullish tone to see the start of a minor corrective decline to retest the former major ascending channel support, ascending channel resistance now turns into a pullback support at 37,570, also confluencing with the minor swing low of 14th of February. Okay, then Hang Seng Index. So Hang Seng Index going to be remains bullish. So price action managed to actually now surpass, playing around with this, hitting this resistance zone that we highlighted yesterday, the 16,070/250. RSI, there is no signs of a bullish exhaustion as well, because yes, it's overbought, but not really that extreme overbought yet, and there's no bearish divergence. All right, so the RSI going to slope higher high. Okay, what we could see over here. So given the positive reading in the hourly RSI and the price action right now, we will tighten today's key short-term pivotal support level to this level over here. So instead of using 15,540, okay, we tighten it to 15,720. Okay. Okay, so this will be the next support level instead. Okay, so tighten the key short-term pivotal support for the Hong Kong 33 or Hang Seng Index to 15,720. Maintain that short-term bullish bias for this ongoing potential counter trend rebound. All right, above 16,250 exposes the next intermediate or near-term resistance at 16,525, which is the congestion area over here from 4th Jan to 8th Jan. Okay, at this point in time. And however, a breakdown for sure below 15,725, there is an hourly close below it, will negate this ongoing short-term bullish tone to see that choppy decline slide back to retest 15,440. Okay, so still maintain that short-term bullish bias on the Hong Kong 33 with a tightened key short-term pivotal support for today at 15,720. Then what's cooking for the German 30? So German 30 going to spike up and almost hit the resistance level that we highlighted, 17,130, 17,155. So what's interesting over here is that I highlight the German 30 is going to trade within this expanding triangle range configuration that I highlighted in this two gray line over here. Now it already hit the upper limit of this expanding triangle range configuration. We also confluence with the resistance that we highlighted yesterday, 17,130. And what's interesting, upon hitting this level, it shaped higher high, but the RSI is not showing higher high, but the RSI is showing lower high instead, and it's hovering at close to the overbought level. So what it means that this push up over here is losing upside momentum by the flashing out of this bearish divergence condition in the hourly RSI. So with that, right, it means that short-term momentum is losing upside initial. There could be a risk of a mean reversion coming back into play. That means the price action going to reintegrate back below, at least back to the medium, the middle area of this expanding wedge configuration from a short-term basis for today. Okay, so with that over here, right, I'll be using 17,130/17,155 to slip back to flip to a bearish bias for a potential mean reversion decline within this expanding range configuration. Taking things one step at a time, first support level to watch will be 17,000, followed by 16,950, which correspond with the upper the upward sloping 20-day moving average as well. And if you do the FIBO retracement of the last push up from Wednesday low all the way up to yesterday's high, it confluences with the 50% FIBO retracement as well at 16,950. Only hourly close above 17,155 will invalidate this potential short-term mean reversion decline scenario to see a potential continuation of this up move to test to expose the next intermediate resistance at 17,200, okay, which confluence with the 1.618 FIBO extension level as well that I drew over here from the low of 14th of Feb, project from 14th of Feb this swing high, project it to the 15th of Feb minus swing low. All right, so net overall, given the bearish divergent condition that is being seen on the hourly RSI, we will be flipping to a bearish bias for a potential mean reversion scenario, mean reversion decline scenario, as long as 17,155 short-term pivotal resistance is not surpassed to the upside. So that's for the German 30. US market, Dow Jones Industrial Average. So US Wall Street 30 continue to remain bullish. Price action, the hourly RSI hit the overbought level. Now it's trying to exit from the overbought level, but the way it hit the overbought level, there's no bearish divergence. Price action is going to shape higher high. So potentially there could be a pullback taking shape. So this pullback over here, first pullback level to watch will be at 38,560 for sure. Previously, that was the resistance that we highlighted yesterday. Okay, then maximum pullback, the 20-day moving average. So with that, as long as the pullback managed to hold this 20-day moving average, which is right now our Titan key short-term pivotal support level for today. So as long as any pullback managed to hold between this zone here, not breaking down below the Titan key short-term pivotal support at 38,365, we will still maintain the short-term bullish bias on the US Wall Street 30. First resistance to watch for sure for today will be at 38,950 / 38,970. Only hourly close below 38,375 will see an extension of this potential minor corrective decline, the minor corrective pullback, potentially extending to retest this Wednesday exposed US CPI's data induced sell-off swing low at 38,065. Okay, so still maintaining the short-term bullish bias on the US Wall Street 30 with a Titan key short-term pivotal support. Nasdaq 100. So Nasdaq 100 yesterday going to churn higher as well, higher high, higher low, but hasn't hit the overbought level yet. So with that, we will be using a Titan key short-term pivotal support for today, given that it has already broken above the first resistance that we had yesterday at 17,840 or 17,800 level. So using 17,630 as my Titan short-term pivotal support level for today, which is corresponding with the upward sloping 20-day moving average as well. Maintain that short-term bullish bias on the Nasdaq 100. First resistance to watch for sure will be the swing high area of 13th of February at 18,000/18,030. Above it, sees the next near-term resistance to come in at 18,220/18,270, which confluence with a Fibo extension level. Only an hourly close below 17,630 will negate this short-term bullish bias to see a retest on this week swing low area at 17,500 level. So net overall, still maintain that short-term bullish bias in the major stock indices that I covered for your asset for the German 30 due to that bearish divergence that is being seen on the hourly RSI. Now, what's next for WTI crude oil? So WTI crude oil going to remains below that 78.40 short-term pivotal resistance, which is the range, the triangle range resistance that is in place since the high of the 15th of November last year. Okay, so it's going to churn like a Venus symmetrical triangle range resistance. So with that, for sure 78.40 short-term pivotal resistance level. So right now, the first support level to watch out for will be perhaps this area over here. Okay, so sorry, this area over here. Okay, slightly below the 200-day moving average at 77.25. Below 725 exposes the next near-term support level at 75.75, which is pretty much key, at least in the intraday basis. Why? Because it managed to bounce from 12th of February, bounce off from yesterday as well, and also conversing with the 20-day moving average. Okay, only an hourly close above 78.40 will invalidate this short-term bearish bias being a range resistance to see potentially a kind of a range breakout to test the next resistance at 79.80, which is the swing high area of 14th of November and 1st of December. Now, spot gold, XAU/USD. So spot gold going to play around with the 2000 psychological level, but still below that 2013 short-term pivotal support, pivotal resistance level that we have in the last 2 days. So the RSI managed to actually now going to slope downwards over here. Okay, giving some signs that also a bearish divergence are going to display this bearish divergence despite price action going to be sideways around the 2000 level. Okay, so indicate to us that this push up here is losing steam as well in the last two session. So with that, I'll be using 2013 as a short-term pivotal resistance level, still maintain that short-term bearish bias on spot gold XAU/USD, but the first support level to watch will be slightly higher for today, will be at 19,086, which is this week's swing low area. All right, so only an hourly close above 2013 will invalidate this short-term bearish bias to see the continuation of this rebound to retest the 50-day moving average, okay, and 20-day 50-day and 20-day moving average that is acting as a resistance at around that 2027 level slash 2036 level, which is the minor swing high of 8th of February and 9th of February. So i.e. overall net still maintain that short-term bearish bias on gold as long as 2013 short-term pivotal resistance is not surpassed to the upside. Okay, so that's pretty much sum up for today's daily dose of market insight in terms of the short-term technical outlook. So very quickly, let's take a look at what are the key data to look out for today. So today is Friday. It's a rather quiet session on Friday. So nothing key to look out for in terms of the European session, except that we have the retail sales for UK that is out at 3 p.m. Singapore time. Then thereafter, in the US session, will be pretty much quiet except for the PPI data, producer price index, some kind of inflationary data as well at 9:30 p.m. Singapore time. Okay, so with that, we do have a Federal Reserve official speaking, Fed Barr at 10:10 p.m. Singapore time, followed by Megan consumer sentiment flash data. So that's a flash data for month of February at 11 p.m. Singapore time. Okay, so with that, that is the key data to look out for today ahead of today's session for the rest of today. So with that, do have a great weekend ahead, and we shall speak again on Monday. Thank you.